Good day, all, and not a bad day for the market. It's not a good day, but not a bad day in the sense that the benchmarks are coming back with the NASDAQ composite, not surprisingly, leading the comeback and just about reaching the flat line on the day after being down about, I think I got the numbers here, about actually on the lows of the day, about 130 points or 1.23%. Dow is down about 1.12% after being down 2% at the lows of the day. So I think we can call that a better than expected midday run, because based on how we opened, and we'll get to why we opened low, what was happening, what is motivating investors to take the risk on button, flip it upside down, and start to be risk off. Will it continue? Well, remains to be seen. We'll talk about the likelihood of it continuing today into tomorrow and what we have ahead. So with that, let's talk about the big news this morning. We come into the day, first of all, with European markets down and futures down. And European markets are down today because bad PMI data, and moreover, the GDP number for Germany was down more than 10%. So it was actually 10.1%. Now, just for clarification, edification, the Europeans, UK, the EU, a lot of other countries do not calculate GDP the way the United States does. The United States calculates its quarterly GDP numbers on an annualized basis. The Europeans do not. So Germany coming up with a 10.1% negative GDP number for Q2 doesn't sound as bad as the United States number today, which was minus 32.9%. But really, they're fairly close. There is no way of knowing, because how the U.S. annualizes the GDP number is a little bit beyond my understanding. There are some nuances to the annualization of taking the quarterly numbers. So I don't know how that's done, and I apologize for that. I could dig into it, but it's too nuanced to make it worthwhile. The headline number is what we're concerned about. The headline number in Germany for GDP for Q2 down 10.1%. For the US, down 32.9%. Probably somewhat equivalent in terms of whether you wanted to annualize the German or you wanted to just make the US simply a quarterly number, not annualized. So still, big numbers, big losses, and for the US, unprecedented, first time ever at that kind of level, just not unexpected. And in fact, better than expected, because the consensus estimate was for GDP to be down 34.5%. It was down 32.9%. Pretty ugly nonetheless, and a testament to what's going on. The GDP number in Germany and the talk coming out of Germany and Europe was that the spike in coronavirus incidents and hospitalizations and deaths around Europe was impacting European GDP, was impacting the reopening across Europe. And certainly it was mentioned in comments by German officials as to some of the impact that it was having. They thought they would be further along on the curve, past the steepest part of the curve, and certainly on the downside, and they're apparently not. And there are other countries that are talking about closing down major parts of their countries, if not the cities, if not countries. So we're not anywhere near out of the woods. We're seeing the same thing here, and the markets reflected that this morning, that if GDP in Germany can be down that much, and then call it forward guidance out of officials was negative, that given that GDP, they're not seeing not having the expectations that were believed to follow suit on this bad number, which would be, well, we're past it and we're on our way coming out of this. No, to the contrary, there were warnings across European officials, by European officials, including the EU, some commissioners, that the countries were not seeing a return to business and normalcy as had hoped for, and we're seeing, to the contrary, slowing down and production lines and factories being shut, and potentially cities and areas being locked down again. So very bad news out of Europe. The European markets just closed. The London FTSE ended up the day down 2.31%. The DAX, German DAX, down 3.45% on the day. And the CAC 40, the French bourse, down 2.13%. So hammered across Europe for sure. And the other countries, similar results, down mostly more than 2%. So not so good leading into the US, but those are the closes. But coming into the US Open, the negative numbers out of Europe, GDP number in Europe, and in particular for Germany, GDP in the United States, better than expected, but down badly, certainly upset futures traders. I watching the numbers come out at 8:30. Futures really didn't do much. They moved a little bit up and down, but they really stayed around the negative side where they were for all of the benchmarks. And that's because a lot of this was built in overnight, and the understanding was that if we had a bad GDP print, things could get worse. We didn't have such a bad GDP print relative to the consensus, but what was disconcerting was an increase in the initial jobless claims. And that's what really took the markets down at the open. Instead of rebounding somewhat from better than expected down GDP numbers, the increase in initial claims by about, not significant, but still an increase of about 12,000 week over week to 1,434,000 initial claims last week. So jobs aren't returning. People are losing jobs. Initial claims rose. Not good. Continuing claims, even worse, rose by 1 million to 17 million. That was a stunner. So much for workers getting back to work. Just doesn't seem to be happening. In fact, the opposite is happening. Now, next Thursday, we get the July numbers for the month, and it doesn't look like now there's going to be another 4 million jobs added. We are probably going to lose jobs on the month in July. So we get that figure next Thursday. It's going to be very important. I think the markets are going to sort of drift. They may falter here. They faltered this morning. They're gathering their strength, but we have a long way to go before the close today. We certainly have a long way to go till tomorrow's close. And between now and then, we've got a slew of earnings coming out after the bell today. And if for the big tech companies, Apple, Amazon, Google, and Facebook, they are much better than expected, then I think we'll see the markets revive tomorrow. And there are other big earnings coming out today. It's not just the big tech stocks. The market certainly can rally. However, if those big tech leadership names, on the heels of getting beaten up yesterday, their stocks didn't get beaten up yesterday, but their CEOs got beaten up in the subcommittee hearing, the so far so good, but today's going to be the day. It's all about earnings. If the earnings are poor, if forward guidance is poor, and subject to shall we say investor fears, we can see the market certainly turn down, and perhaps the NASDAQ composite lead the way down tomorrow morning. So a lot remains to be seen. We got a lot ahead of us this week. We're only Thursday midday, so it's going to be a long Thursday. It's going to be an intense close for sure. It's going to be intense after the close with the earnings announcements, and then it's going to be pretty interesting open tomorrow. So all the way through tomorrow evening, going to be really tumultuous. Anything can happen. So we'll take a look at some charts, and I'll tell you how things look like they're setting up and what the possibilities are. Maybe put some probability numbers on what might happen. So that being said, we touched on initial claims. We touched on continuing claims. We're looking at total still, and it's slightly more total number of U.S. citizens getting some kind of relief, help, unemployment or gig unemployment package. 30,202,000. That remains inordinately high, and certainly not a welcome number. So besides the big cap tech stocks, Ford reports today, DuPont, Gilead, Eli Lilly, Procter & Gamble, Newmont mining. So we've got some really big names. We've got a cross section of the economy, everything from healthcare and pharmaceuticals to car manufacturers to industrials, materials. We've got it all really, and we're going to have a snapshot throughout the day and certainly at the end of the day of how these earnings are coming out. Again, the big news will be the tech earnings. So can they drive the market higher or lower? Either way, they can take it either way. Something I came across that is we talked about months ago here, which is has resurfaced and is even more telling and yet again more frightening, is what may be happening in the commercial mortgage-backed securities market. And we talked about that in the past, how CMBS were under pressure because you have all of these companies who have leases, they have real estate, and the mortgages that they have on those have been packaged into securities and sold to investors. And investors buy those oftentimes for the yield. Well, what backs those mortgages? Obviously, the ability of the individual companies to pay those mortgages, as well as the value of the underlying real estate. Well, we're seeing perhaps revaluation, the beginning of the revaluation of some commercial property, and none of it is to the upside. None of it is to the upside. So around the country, especially in major metropolitan areas, most particularly New York, commercial real estate under duress. And therefore, the commercial mortgage-backed securities market under duress. So here's something that came up today that I just going to read as is. This is from a very popular site and one that I also like very much. A lot of interesting articles, and then some of them are the in-depth articles written by some folks who are in the business, deeply embedded in the business, know the business, came out of the business, out of banks and hedge funds. So some really interesting stuff here. This is, again, out of Zero Hedge, and it's titled, "An Unprecedented Move. Congress Proposes Taxpayer-Funded Bailout of $550 billion CMBS Industry." So I'm just going to read it as is. Well, with everyone and everything else getting a bailout, may as well go all the way. 2 months after we reported that the state of California is trying to turn centuries of finance on its head by allowing businesses to walk away from commercial leases, in other words, to make commercial debt non-recourse, a move the California Business Properties Association said could cause a financial collapse, attempts to bail out commercial lenders have reached the federal level, with the Wall Street Journal reporting that lawmakers have introduced a bill to provide cash to struggling hotels and shopping centers that weren't able to pause mortgage payments after the coronavirus crisis shut down the U.S. economy. The bill would set up a government-backed funding vehicle which companies could tap to stay current on their mortgages. It is meant in particular to help those who borrowed in the $550 billion CMBS market, in which mortgages are repackaged into bonds and sold to Wall Street. What it really represents is a bailout of the only group of borrowers that had so far not found access to the Fed's various generous rescue facilities, and that's where Congress comes in. To be sure, the commercial real estate market is imploding, and we reported on that at the start of the month, with some 10% of loans in commercial mortgage-backed securities were 30 or more days delinquent at the end of June, including nearly a quarter of loans tied to the hard-hit hotel industry, according to TREP LLC. Brutal stuff, brutal stuff. And then this is part of some of what we discuss here in terms of pricing transparency. How do you price securities? How do we know what the value of the real estate is if securities aren't priced accordingly because we've got government bailouts? How do we know if the hotel industry is going to survive, or who's going to survive, or the cruise line industry, or any of the other industries that are being supported? Now, I don't have a problem with supporting these industries because we know it was an existential threat, not only to humankind, but to certainly commercial operations across the world. So to entire economies, this was a frontal assault, existential threat to to existence of many businesses. And I don't have a problem with the bailouts. The problem is that there are just too many of them. They've gone on for too long. And now we're at another juncture where we don't know how to value securities, how to value real estate assets, how to value a lot of assets. And the problem with that is not that the support that they're getting isn't perhaps justified or temporary or worthwhile, even on a temporary basis. It's that it's not going to be temporary. That's the problem we should all have, is how temporary is temporary? How extensive is this backstopping going to be? So to me, I don't see the Fed pulling out anytime soon. I just don't see it. Is the Federal Reserve all of a sudden going to risk everything that they put on the line to save by raising rates? It doesn't matter, come hell or high water, if we get an inflation spike, it's going to be overlooked. Oh, that whole moving target, that 2% target nonsense. If inflation gets to 4%, the Fed can't move. It cannot raise rates. Rates will rise on their own. The bond vigilantes will move rates higher, and the Fed won't be able to do anything about it. This is the problem we're going to face. Everything else you see and hear and people talk about is going to be secondary to what could happen, what will happen when interest rates start to rise on their own and the Federal Reserve isn't ticking them up and can't do anything about them eventually spiking, because then the bottom's going to fall out, because all the companies that have been sustained, the zombie companies, the CMBS, on and on and on, will not be able to refinance at these rock bottom rates. That's the beginning of the end. What the end looks like, I'm not sure yet, but that's a reckoning. And that's what will trigger the reckoning. So sorry for the bad news. It's not in sight yet, but I believe we're going to start to see some inflation impacts in the first quarter. We're not going to worry about it. No one needs to worry about it until those inflation impacts really start to move the short end of the bond market higher and steepen the curve, the yield curve, substantially. So that is probably more than a few quarters off. Let's hope maybe a year or two off, but at some point it's going to happen. And we talked a little bit about the other day why, and one of the reasons is the velocity of money, which wasn't present and didn't impact inflation at all from 2009 onward, is going to rear its ugly head because of the way money is being distributed now and the fact that supply is going to continue to be tight for a lot of goods and services. So there we go. It's not here yet, so let's not worry about it. Let's take a look at the market, and here, sure enough, the NASDAQ composite, the honey badger that it is, plowing forward on the plus side by a small amount. S&P, Dow certainly doing their best to turn around. The Dow is down 1.17%, down 310 points after being down 547 points at the low today. And S&P down 0.75%. NASDAQ Composite on the plus side by 0.11%. VIX spiking today up about 9%. And we'll take a look at gold and silver and some other action, most notably in the Treasury market. Yields on the 10-year down to double nickel today, 0.55. So I think that is a recent low. They had been ticking up and all of a sudden just simply reversed and come some shockingly just crashed right down. So NASDAQ, again, on the upside, NYMEX, and we got WTI having broken back down through 40 at 39 and change today. Brent is also on the downside today, gas on the downside, and we're looking at copper also down a little bit today too. So you're looking at our metals, gold down 1.21%, silver down more than 4%. We put a play on silver the other day in one of my services. And we bought some puts on SLV. We'll take a look at that and see how that trade is setting up, because we talked about that here, and I spoke to you about gold, GLD versus silver, the iShares SLV Silver Trust, and pointed out all of the gaps in SLV versus GLD. And that's why we targeted SLV and not GLD for a downside move. And we're getting the beginning of that today. Can we get more? If the market trades down more and significantly more, then yes, we'll get some correlation selling, and we'll see probably gold. We'll see some profit taking in gold. We'll see more profit taking in silver. And we'll see a profit taking in a lot of stocks that have rocketed higher, including some of the pharmaceutical, healthcare, coronavirus lottery type stocks that have gone through the roof for weeks, if not months. There's a lot of those out there, and some of them in a harsh market sell-off will just get hammered. That's because, again, a lot of retail investors who have helped drive the market up are going to take profits, and a lot of them may be savvy enough to start betting against the markets. And if they know if they can create momentum on the upside, they know that they can create momentum on the downside, because they know they're affecting other retail traders like themselves. So markets have entered a whole new, shall we call it, what do we call it? I don't know what it is. It's a new paradigm. It's almost like a new dimension with retail leading, and retail leading on the way up was all good, but retail leading on the way down could cause for some crazy moves. So yeah, don't think it can't happen, because it did happen on the way up. Ipso facto, it can happen on the way down. All right, so I've got a couple questions here. Shelly, hi Shelly, hi Shah. So the market basically pulled a honey badger. Read the antitrust hearing yesterday. Yes, and my contention is that this week is going to be a tumultuous week and potentially could go either way. My leaning is that given where the tech stocks were from 2 weeks ago, when they had that crazy day when we made a new all-time high in the NASDAQ Composite and the NASDAQ 100 by 2%. And then we collapsed, lost that 2% gain that we made, and we collapsed 2%. So we had a 4% flip. That was a warning sign, a shot across the bow. And some of those stocks have looked like they're a little tired, if not maybe leaning towards the rolling over side, having not rolled over, but having leaned into that. I believe that yesterday and moreover today's earnings, if they're negative, if their investors don't like what they hear, could be the tipping point, and we could see a sell-off in tech. Now, yesterday, you're absolutely right, Shelley. They're all just a bunch of honey badgers just clawing at the every congressional hearing that they face. And this was Bezos' first public appearance in front of a congressional body, and frankly, I thought he held up relatively well, considering he was presented with some pretty harsh evidence of what Amazon has done. So we know what they're capable of, but there's certainly hard evidence of what it has done. Evidence was brought against Facebook, also Google. Apple, yes, to some degree, but wasn't beaten up as hard. And Tim Cook got far fewer questions. Google, I think, got beaten up the most. They seemed to be in everyone's crosshairs. But nonetheless, the investors looked at that and knew going in, based on a lot of commentary going in, and there certainly was no lack of commentary from every quarter, that the U.S. antitrust laws aren't conducive in their current state to take any of these companies apart. It's just not there. There have to be some dramatic changes. What's there are the regulations that do exist have not been followed. So that's a problem, as opposed to going after them, breaking them up would take years legally to do. Of course, they would be fought at every turn. So investors, as they're watching, and I watched the whole thing, was quite the show, needless to say, just as expected, as you can imagine if you didn't watch. And investors said, who cares? Just keep going, and they did, and the stocks all ended the day higher yesterday. However, that didn't prevent them from taking a hit this morning, and they have recovered, but the day is far from over. So can we end up higher on the day across the benchmarks? Yeah, absolutely we can. Can we end up lower? Yes. Can we end up significantly lower? Yes. Again, this is going to be one of those weeks. Today, the close is going to be important. Going into the close, starting 2 o'clock into the 3 o'clock hour of heavy trading, and again into the close, where as positions are set up for tomorrow, it's going to be very interesting, and all day tomorrow is going to be interesting. Certainly, again, driven by earnings after the close today. Tomorrow is going to be maybe a make or break kind of day. If it's a break kind of day and we get broken in the morning, if futures are down because of earnings impact from after the close today, and we open significantly lower, we could see heavy selling all the way into the close. We're not there yet, and that's certainly we're probably far from that, but that's a possibility. That's how important this week is. That all being said, earnings come out great, and all of this consternation of how this week could go will pass, and we'll have a reasonable close tomorrow, and it's all just back to business on Monday. So could go either way. That's how important this week is. So it's been fun to watch it, and fun to share some of this time with you. We'll certainly share some more tomorrow. Tomorrow's going to be fun. So a couple more questions. Joe, any idea the move on MDB on no news? No. Let's take a look at MDB. There's just a lot of stuff that's moving, a lot of positioning. And when you see positioning, fragile positioning, I call it, I'm always a little bit concerned about what state of mind investors are in, because when you see fragile moves, then investors are apprehensive about their commitment one way or another. And usually it's to long positions, and that means they're prone to profit taking and or selling. MDB is MongoDB Inc. And I don't see much going on there. That's what you were asking about. And I believe, Joe, it is MDB. I don't really see much going on. It's up 3.63%. I don't see anything crazy. The stock is moving sideways. Looks like it's trying to consolidate. So I'm not sure if you're seeing anything there that worries you, but I don't see much of a move other than the types of movements it's been capable of making. Sergio, hey Shah. Qualcomm up big after earnings. Do you think the gap gets filled, or is it only up from here? Let's go take a look at Qualcomm. And for everybody else, it's QCOM symbol. If you're taking a look at all this stuff, and you should be, because there's a lot of stuff I'll talk about. I'm looking over at one of my screens on the side here, and but it's good for all of us to be looking at the same stocks, the same graphs, so you can get an understanding of how I look at the graphs and how a lot of traders look at these graphs. And this is certainly after almost I'm coming up on 40 years in this business as a professional trader, and so what's happening on a screen is important to understand, because it has relevance for all types of technical setups. So Qualcomm, in fact, we'll take a look at that. We'll put that on our stocks to look at graphically. Yeah, we're up 12.43%. We're going to see a stocks gap like that on big and better than expected earnings, and certainly on forward guidance. If any of these companies are indicating that their full year earnings are going to be as previously expected and or better than previously expected, they upgrade them, then we're going to see gaps like this. So can that gap get filled? Yes, that's a huge gap, and yes, we'll take a look at that graphically. This is the kind of position where you got to love this, but yes, that can get filled. If the market comes back in, that will get filled, but right now the market's trying to brush off everything and move higher. Does Qualcomm have higher to go? Yes, it does. At some point, that gap, however, will get filled. So I'd be concerned if you had a great ride in it. At some point, I want to take some profits, or maybe put on a little bit of a hedge, maybe buy some puts with the stock rallying like that. So you can pick up some puts probably a lot cheaper today. So that's the way I would look at Qualcomm. But yes, it's certainly got more to the upside. If the market continue higher, it's going higher. Kurt, what do you think about Intel after its drop? Well, it's a typical example. You're going to see when a company doesn't meet expectations, you're going to see just a bloodbath. And Intel, absolute bloodbath. At some point, it's a buy. I like Intel and want to own Intel. If the market, it's really about the market right now. If the market over today and tomorrow strengthens, I might be looking for a place to buy into Intel. I like it. I like the drop down here. I think longer term, the stock's going to do well, but that's ugly, and that's a gap. Obviously, we're going to take a look at Intel in the chart too. And that gap to the downside also can get filled very easily to the upside, which would make it an awfully nice move to the upside. So we'll take a look at that. I do like Intel. I think, is this overdone? It's a little overdone for sure. It doesn't mean that Intel doesn't have a little more to go on the downside. The way it's trading right now, it could certainly test its lows at 43 and change. And again, I'm going to say it again and again and again, at the risk of being obnoxious and repetitive. It's really going to be about the market for the rest of today and tomorrow, and maybe certainly through perhaps next week. But we're talking about in the immediate with Qualcomm and Intel. Right now, it's what's going to happen now. These stocks have made these moves. Investors are looking at them, and they're either going to sell them more if the market's going to go down, or they're going to look at this as a buying opportunity if the market turns around and goes up. So same thing with Qualcomm. We'll take a look at those graphically. Michael, no ask Q box. So nice shirt. No, thank you. Old Brooks Brothers. I had to wear it because poor Brooks Brothers headed into bankruptcy, but it's an old Brooks Brothers shirt. Thank you very much. Thoughts on oil stocks? Took it on the chin. Buy the dip. Now here's the whole thing on oil. If GDP is heading in the wrong direction and countries aren't optimistic about a rebound, we're going to see a slowdown in global growth. And of course, that's going to impact oil demand. Pretty simple equation. So oil is going to get a little hit. I'm looking at USO now. That's down 3.11%. I'm a longer term bull on oil. I think WTI is going to hit 50 by the first quarter. So I'm long oil. I'm not worried about a move like this. We're going to see this. Generally speaking, the trend has been higher and it's been firm, in my opinion. So a dip is just part of the market action. I'm not convinced that oil is going to roll over. I just don't see. We'd have to see a lot slower growth. We have to see a lot more knocking down of potential GDP growth, and we have to see signs that oil supplies are considerably higher. They're not, and with oil down here, and with the leverage issues that American oil producers have, we're not going to see a rush of supply. So I'm again a long oil player, and so I see WTI at 50 and maybe a little bit higher than 50, certainly by the first quarter. I see it at 60 by the third quarter of next year, and probably holding there and maybe firming up there and potentially going a little bit higher because I do see some supply issues. Okay, let's see. Ruby, buy point on silver and gold miners, GDX and silver. Okay, let's just take a look at those. I'm going to put those, Ruby, on the stocks to look at list so we can look at them together. Because we're going to look at gold and silver, so we'll look at the miners too. Thank you for that. And IRBT, one of my favorites. You like that? The iRobot, Ruby's asking about. Yeah, I think it's a dip. Would I jump in by right now on that dip? No, it's the market right now in here. And again, I'll show you what I'm looking at. I'm not sure that this bout of selling is over. I know it's not going to do a lot of us any good, but we'll probably have a clearer picture on Friday at the close whether or not this bout of selling is going to be over. If it's not, I don't want to jump into anything right now. I want to wait. If it's over, yeah, then iRobot probably a good spot to get in. But that being said, just because it's up a little bit today, I don't think it's not going to leap forward at this juncture. So I would hold off on it. But at some point, yeah, you want to get into that if you haven't gotten in before. Walter's asking Amazon after earnings for Friday. Wow, I wish I knew, Walter. All of them are going to be absolutely critical. I've got to believe that Amazon's numbers are going to be they're going to hit it out of the park. So the expectations are going to be high. Question is, will they beat? And what will they say? What will their forward guidance be? Now, I expect Amazon to provide some forward guidance. It doesn't mean it's going to be positive. Their forward guidance may be that they've had such a great quarter because of the coronavirus that they may see things slowing down if the economy starts to open up more. So remains to be seen what their guidance would be, but they're probably going to have really out of the park numbers. And the problem with that is the expectation. If they come in under, investors may just think, okay, it's had the rise, it's really topped out, and sell on the news. So yeah, I wish I had a thought for you going into the earnings today, and how to play it and prepare for it. But I really think it could go either way. I've said this. I said it on Tuesday, and I've said it again today, and I'll say it now yet again. Some of these stocks, these big mega caps, are just in a precarious position, technically speaking, and it's going to take really good earnings beats and investors to return to like the risk on mode and return these leadership stocks to their position as leaders. If that doesn't happen, then we're in for a tougher time. So yeah, that's all I can give you on that, Walter. I wish I had some smart play for you, but I apologize, I don't. Peter, how much does the merger investigation affect money and INWK. So I'm not sure. Inner workings. I don't know. I don't know that stock. I'm going to have to get bone up on what Inner Workings is doing in terms of merger. So I apologize. I'll get back to you on that tomorrow. But that's a heck of a move. So if the stock is moved on some kind of merger overture, Inner Workings downgraded to neutral. That's from July 16th. So I don't know what the news is. Maybe you can help me out there if you don't mind. Peter, just let me know what it is, what a merger investigation you're talking about, and so I can address it a little bit better. So I apologize. But let me move on to John. Took your advice on XLK and did 6% stop. So far, so good. Good. Let's continue and hope that may play out. Again, the issue with the technology sector isn't that the earnings aren't going to be good. It's that are they going to be good enough, and are investors going to start to take more profits? The last 2 weeks, these stocks have fluttered. So they are at a point. They're not weak, but they're at a point where they could see more profit taking. So you're okay with XLK to obviously, John. It's going to be about today at the close and what the numbers are. Walter, you're welcome. All right, let's have a quick look at, and if you guys have any more stocks you want me to take a look at, fire them off right now. I think I covered most of your questions for now. We'll come back and see if there's more. But let's go to the screen, take a look at just a whole bunch of stuff real quickly and just fire out what the market's saying. Doing NASDAQ, up 0.25% now. So you really, the honey badger just scratching higher. Gotta love that. All right, first up, silver and gold. Let me start with gold. Let's take a look at GLD. And as far as gold goes, seeing a little bit of a down day today, and there was some news about India not prosecuting retail investors from hoarding gold. So you would think that that wouldn't be a negative. I don't know if that really moved the market. I'm not sure what the market is moving on today as far as both gold and silver selling off. Could be just some profit taking. Could be as the market sold off this morning, folks thought, okay, some of the ride is over for gold and silver too. Let's take profits, because there's no harm in taking profits. So maybe just a little bit of that. So as far as gold, you still got this gap, ladies and gentlemen. Let's make no mistake about it. You got this big old gap right here. And that obviously is something that we look at. Are we going to fill that gap? There we go. Got the nice big gap, and so we can easily come back down to 179, which is not a tremendous move, but if it does that, then will we consolidate there? Will gold then be tested, and what will we do? The prospects for gold are still good, but you have this tremendous rise, and at some point people are going to take profits. One of the things that's surprising that we haven't seen, that yesterday, in fact, we didn't see gold even go a little higher, is Goldman Sachs came out and talked about perhaps the end of the dollar as the world's reserve currency. That would bode well for gold for sure, but it didn't do much. It did the day before. That yesterday is they did yesterday, but it didn't, and it ended up pretty on a nice note. But we're not seeing any follow up today. We're seeing some letdown. I would have imagined on the heels of Goldman saying something like that. And Goldman wasn't the only bank firm that talked about the U.S. dollar drifting lower, if not in some versus some currencies actually falling. The euro is falling precipitously almost, based on how currencies trade. That the gold didn't see more of an upside move today. So far so good. It's holding up, except got this gap down there. That would worry me to fill that gap based on everything that's happening. Why would gold be coming down? Yes, profit taking, but are there other reasons? I think it needs to hold up. Otherwise, this run for the time being may be over. So keep a tight eye on that. If it fills this gap to the downside and just hangs out, and can't gather it and consolidate and move up, the run for gold may be nearing a short-term end. That's the possibility. Now, we talked about silver we talked about the SLV versus GLD and how silver often tracks. I wrote a piece the other day how silver is not a precious metal. It's an industrial metal. And silver does follow gold for lots of reasons, but most of them don't make a lot of sense in the long run. And we talked about gold's ascent being fairly steady. We talked about silver's ascent being full of these gaps. So we filled this one gap here. We got a big gap here. We got another big gap here. So what did we do the other day? We bought puts on SLV. Okay. So our bet is that we're going to fill some of these gaps to the downside on SLV. I see SLV working its way down to certainly to 18 level at some point within the next couple of weeks. If we don't get a turnaround in both gold and silver, it could happen fairly quickly. So that's the way that we played the precious metals and silver. We were looking at gold. I just didn't like the setup in gold to buy puts in gold or GLD or short GLD. Obviously, because of the gaps here, shorting and or buying puts on SLV. Certainly more constructive based on filling those gaps to the downside. So let's have a look at treasuries. Okay, so there's a short treasury, TBT, ultra short, which, by the way, is a good way to play the long side by buying puts on this. So if you think treasury rates are coming down, one of the fun ways to amp up your bet is to buy puts on this particular ETF. Just for some of you that like to play the treasury market using ETFs. So here's the unlevered 20-year plus T-bond, which is a great trading vehicle. And you can see we have from some time ago this sideways channel that the bond market has traded in. Certainly the 10 to 20 plus. This is the 20 plus, but really 10 years also been a sideways trading range. And here we are looking like we're trying to get up to the top level here and break out. And that means that rates are going lower if we break out. And why are rates going lower? If rates are going lower, it's because things are not good. So that is a bit of an early warning and something I worry about when I'm looking at the market, the stock market. Like if investors are betting that the Fed is going to bring rates yet again lower by doing more treasury purchasing, then wow, why are they doing that? The balance sheet of the Fed is certainly heavy enough with treasuries and CMBS and ETFs and everything else. What do they see that is might cause them to buy more? What are investors looking at that they believe is going to bring yields down? Is this a run to safety play? So this is partly how we opened up today based on Chairman Powell's remarks yesterday. And we know that the mega cap techs went up, but a lot of other stocks were very jittery yesterday, and overnight and into the morning, there was a lot of digesting of Fed Chairman Jerome Powell's press conference and some of his remarks and what the Fed had done over its two-day meeting. And essentially it amounted to they're worried. So Yes, we know rates lower for longer. We already got that. We know that. But the Fed seems worried. And if the chairman is indicating that he's worried and partly worried over the closure of some areas because of further virus spikes, investors react by jumping in and buying bonds. And so we've seen a move up in TLT. So one way to play it. Well, let's have a quick look at Qualcomm. And we'll take a look at Intel, and we'll look at some of the miners. Go back to looking at the miners for Ruby. Okay, Qualcomm, here's the gap that we were looking at. This is just a tremendous move. The stock's up 13.5%. And this is absolutely fabulous. You know, if you own it, this is just makes your heart flutter in a good way. At the same time, you wonder about the ramifications of that kind of a move on a stock that, generally speaking, doesn't make those kinds of moves. And are investors going to think the move is overdone? Or is this the launching point for the stock to go a lot higher? I don't believe this is the launching point for the stock to continue from here without doing some backfilling, some consolidating. So I would be very apprehensive that we're going to continue just rocketing higher from here and just take off. So far, so good. But be careful on Qualcomm. Intel. Here's the opposite. So ugly gap to the downside here. And stock has continued to get absolutely hammered. Not only that, we'll take a look at what's going on here, ladies and gentlemen. See what happens here? Here's the 50-day under here. Stock managed really well. And then when it came up, the stock had just proven itself that, like, that's okay. Well, you know, this is a little bit delayed action based on this huge drop. And when it's caught up, then the worst seemed over, and that didn't affect technical trading that much. Now we see this rise now, but we see the 50-day rolling over, and we have a little glimpse of the 200-day perhaps rolling over. So if we get now the 50-day crossing under the 200, while the stock has gotten beaten up like this, the stock could certainly test its lows. So it wouldn't surprise me to see this stock come down. We're close enough down there now where it wouldn't take much as far as filling that big gap to the downside. Yeah, that's going to take time, because when a stock makes a move like this and then continues just to absolutely fall out of bed like that, that just means that gap that you see, this gigantic gap, it's going to just take a lot longer to fill. Will it get filled? Eventually it will. Yeah, maybe the stock has to come down here and consolidate for the stock to then move sideways and to work its way back up. But I jump into Intel right now? No, I want to see if it comes down, touches its lows, in which case I'll start to maybe look at taking a position in Intel to eventually fill that. But right now, this action is pretty ugly. All right, let's take a look at Ruby. Wanted to just take a look at some of the miners. And I believe you've got GDX, Ruby. So you've had a nice run with it. And to me, again, the miners, because they've had a run based on gold's run and, of course, silver, they're going to react the same way gold's reacting. A lot of profit taking here. A lot of people see the miners as a multifaceted way to play the metals. And in particular gold. And so this is a very popular ETF also. So GDX, anytime you have a very popular ETF that is followed, and this trades, tens of millions of shares sometimes in a day. I think the volume right now, let's take a look. It's already 19 million shares. So what's happening is you get a lot of not only institutional interest in these plays, but now you're seeing tremendous retail interest in terms of the crowd that has come into the marketplace since the March action, the lows and then the rise. A lot of retail. Absolutely, positively, institutions do play this. Traders, you kidding me? Traders, big traders in trading desk and hedge funds, they play all of these too. They're playing retail, they're playing other traders. So yes, there's a lot of action in something like this. You're going to see these kind of moves, even though gold itself is only down like 1.5%, maybe something like that. What you're seeing here is more more retail exiting, taking profits, and perhaps other traders trying to push it down to see if they can't force a little selling. So you're going to see that. Is gold? Is a run in gold and silver done? No, I don't think so. I think it's going to be tested, and it wouldn't surprise me to see the miners come back down. It wouldn't surprise me to see actually GDX come down to maybe like the 38 level and look for some support down there. So wouldn't surprise me. Other than that, longer term, just the way gold has been reacting, and the conditions we've talked about haven't changed. So I would hold it if you're comfortable. If you want to take some profits and try and get it lower, that's certainly another way to play it, because you know how I feel about profits. There's always a place in your pocket for some more profits. Here's the silver. It's the GX silver miners. Again, you see some of the same kind of gapping, to the upside here, a tiny bit there, but looks a little shakier to me. And obviously, based on the move, percentage-wise, this moved a little bit more than GDX to the downside. Not a whole lot more, but enough where I think it reflects the drop in silver. So, yeah, same thing. Again, I said we put a bet on against silver, against SLV in particular. So my opinion is where my mouth is, and that's where my play is to the downside silver. So that's all I'll say about that. Just be a little careful in here. I think we got a little bit of profit taking, a little bit of consolidation ahead in both gold and silver. Doesn't mean the run is over for either. I just think we got a little bit of downside, a little bit of consolidating. I think silver can consolidate more. And I think that's pretty much what I wanted to cover with you guys today. Real quick, let's take a look at just how the big boys are doing ahead of their earnings. Facebook, whole lot of nothing. This is what I talk about. Look at this action here. Okay, we got this kind of little bit of rolling over. We're not dead. We haven't rolled over. We got some support here. We got some more support here. We don't want to see Facebook come down to 223. I think it's 225 to 227 should hold. If this gets bad news, could this break? Could there be some profit taking? Yes, that would be the rollover. And if we break through 223, let's call it, then we've rolled over. And if we come down here, then the bloom is off the rose for the time being for Facebook. Amazon. All right, up more than 1% today. Why? Because earnings are supposed to be great and guidance is supposed to be good. And if all that happens, then the stock's going to continue to go higher. That being said, looks just a little bit in between to me. And it's okay that it's kind of turned down a little bit. I worry about coming down here and breaking down at 2,900. If we break down through 2,900, and certainly we could move that there very quickly on Amazon, then we've seen a breakdown here and a rollover, and that would concern me. It would also give me pause in terms of the rest of the market. Apple. Same thing, reacting, today to hopefully good news. Everyone knows that Apple's earnings are probably going to be down a little bit. I think the revenues are going to be down just slightly, and then so the numbers are really strong in terms of consensus numbers for Apple. They're just very strong, surprisingly strong, and so Apple's got a pretty steep curve to climb in terms of their analyst expectations for both revenues and net. And the stock, just great action. If you look at this, just hugging this, and then we get this frightening sort of good night and now we're trying to get back up here. We're still below the trend line here. Granted, it was a steep trend, but we're below that. And Apple coming down on bad news below 373. Be a little nervous about it rolling over. Netflix, we're not going to do today. We got Google, same thing with Google. We got some, just really nice action right here. And however, just starting to look a little tired. And here's what we want to keep an eye on, this level here. If we see Google, and Google's coming down to that $1,500 mark, that just below 1,500, and we got maybe down to 1483 there. Below that, Google's rolled over. So this is what I've been worried about all week. Not worried about it this minute because NASDAQ Composite is up, but that's investor expectation. That's investor expectation for what's going to happen with the earnings. And we're going to see some pretty crazy moves as far as the earnings today. As far as the stocks are concerned, I think some of these stocks could have pretty exciting moves. So I'll be watching them in the after hours, and I know you probably will too. Well, certainly had a really good look at them in the morning at the open, and that is going to determine, I think, our near-term direction for not only the tech stocks, but for the market. So we're at that, it's a very interesting spot. As I get ready to say goodbye, I'll have a quick look at the questions and just tell you the Dow's still holding up. NASDAQ still holding up. S&P, they're off the lows, not on the plus side, but off their lows. Dow's cut its losses in half. NASDAQ the same. S&P the same. NASDAQ has erased all its losses and still remains on the plus side by about 0.25%. Okay, a couple of quick things. Let's see. Walter, you're welcome, sir. Craig is asking, accumulated but trade GLD. Oh, your thoughts on CEF? And you accumulate CEF, Sprott, Physical Gold, Silver Trust. Well, I think that's a smart play. I like it. You accumulate CEF and you play GLD and SLV. I like that. I like that. It's great action. It's up. It's a lot depending on what your entry is or your average price. It's to me, I'll say this. I don't want to jinx it for you, Craig, but it's just a little toppy if we're going to see gold and silver consolidate, just somewhat even. So long term, I like things long term. I pretty much leave them alone. Gold long term. I'm not a gold bug. I've been following gold with you guys as a trade, but you probably have a better handle on it than me. All I would say is, as far as CF, the Sprott, Physical Gold and Silver Trust, if both gold and silver are going to consolidate, it's going to come down. Peter, you're back with good. Thanks. A little clarification. Investigations of INWK for investors concerning the company and officers possible violating federal securities law. Okay, I'll take a look at that, Peter, and I'll address it for you tomorrow. Carnival getting rid of 13 ships. Stocks heading where? Listen, here's the thing about the cruise lines. Where are they going? They're not going out to sea. There are still cruise lines. There's cruise ships with staff still on board because they have COVID and they can't get off and nobody wants them. When I was down in Miami, on the beach, and the beach outside my condo area, just look left and right, cruise ships, because there was no room in the docks for them in Miami, in the port of Miami. Pretty frightening. And then you drive over the MacArthur Causeway, you see them all lined up. But there are so many of them that they're anchored out in the ocean. They're not going out to sea. They're bringing them in, they're rotating them in to clean them and do what they need to do. Then they send them back out. So they're not going out to sea with paying customers anytime soon. And as we see further spikes, do you think people really, I don't care what deals they're offered, are going to risk being on a ship when all it takes is one person to spread the virus, and then they maybe can't make dock anywhere, they can't make port anywhere? Pretty frightening. So I get the speculation in the Robin Hood and retail accounts. I get it. It's certainly fun to play it that way, and you can make some money if you can time it right. You can make money the upside and the downside. Longer term, I wouldn't touch it with a 10-foot pole. Just nowhere near where I see it's going to make a recovery. It's completely speculative. That's the way I look at that. Getting rid of 13 ships, so they're getting rid of revenue possibilities, right? So again, where are you going to go? You're adding debt to stay alive. You're getting rid of ships. Maybe you make some lease back deal for them. Maybe you don't. But if you're getting rid of 13 ships, I'm not sure what Carnival's total number of vessels are and their capacity. But if you're getting rid of ships, Peter, right, you're getting rid of revenue possibilities. So that should speak volumes to us. Also, Peter, Sorrento has home COVID tests coming, $10, 30 minutes. Wow, great. So we certainly could all use that. It's a matter of efficacy, right? I mean, there are tests out there, and if we can get a $10 test, a 30-minute test at home, and efficacy is 100%, there are no false negatives, then that's important. Haven't and will not touch the cruise lines. Good. Stay safe out there. Okay, I think I got everybody. Craig, did I get you on your CEF? Yeah, long-term hold. Okay, good. All right, everybody. Thank you very much. It's going to be fun watching at the close today with all the earnings coming out. It's certainly going to be exciting, and tomorrow's going to be equally as exciting. I look forward to seeing you guys at 11:45. Till then, stay safe. Bye.